All right, welcome to the deep dive. Today we're jumping straight into some crucial financial signals from November 19th.
And they're flashing some serious warnings.
Yeah, big time. We're on a mission to unpack the signs of market weakness, and the message seems pretty clear. High risk is back on the table.
And defensive positioning is suddenly key.
Absolutely.
Yeah.
And if you're in a sector that's sensitive to the economic cycle, and we're looking at you in molecular diagnostics and biotech, this shift could impact your capital planning, like right now.
The first thing that just jumps off the page is the investor sentiment. I mean, you look at that Bank of America survey.
The one that pulled about 172 fund managers?
That's the one. These are people managing almost $500 billion. And the data point that's got everyone talking.
The cash holdings.
Exactly. They're at a record low,
Yeah.
just 3.7%.
Okay, let's break that down. Why is such a low cash balance a huge red flag?
It's all about dry powder. If everyone is fully invested, sitting on almost no cash.
It means there's no capital left on the sidelines to buy when the market takes a dip.
Precisely. That lack of liquidity is a classic, a textbook sell signal. There's just nothing there to cushion the fall.
Right. And then you add the fear on top of that illiquidity. I saw that 63% of those same managers think stocks are overvalued.
They do. But the really interesting part is what they're scared of specifically.
Artificial intelligence.
You got it. 45% pointed to AI investment as the single biggest market risk, which is kind of wild when you think about how it's been the market darling for years.
So is this just a fear that the bubble is finally ready to pop?
I think so. The run-up has just been so fast, so unsustainable. They're pricing in the risk that if one of the big AI players stumbles, the whole thing comes crashing down.
And we actually saw those fears turn into action, didn't we? Markets globally took a hit.
Oh, yeah. The UK's FTSE 100 had its largest single-day drop since April, pulled back around 1.27%.
And it felt like a broad sell everything day, not just stocks.
It was. Crypto, gold, everything was down.
So what's driving this from a bigger perspective?
Well, you have to connect it to the macroeconomic headwinds that are building. Moody's just put out a forecast for global GDP growth.
And it's slowing down.
Significantly. They're predicting it'll fall to 2.5% in 2026, down from about 2.9% this year. That kind of deceleration is a huge problem for any company tied to general economic health.
And that's where it becomes directly relevant for you if you're listening from a cyclically sensitive field.
Right. Molecular diagnostics, biotech, these fields depend on steady R&D budgets, big equipment purchases, strong export markets.
So slower growth means those budgets tighten up, raw material costs can rise, and capital just doesn't flow as freely.
Exactly. And now you have this collision, right? Slowing global growth is meeting these sky-high tech valuations.
Which leads us to what you called the ultimate stress test.
Yep. Over half the managers now believe AI investments are just outright excessive. So all eyes are on NVIDIA's upcoming financial results.
The canary in the coal mine for the whole tech sector.
It really is. A bad result there validates every single one of those bubble fears. It could accelerate that defensive shift we're talking about.
So, to put a bow on all this, the takeaway is the market is flashing red.
I'd say so. Low cash, high valuations, and a general feeling that the party's winding down.
The signal is strongly favoring defense over expansion. That seems to be the consensus.
Which leaves you with a really important question to think about.
Okay.
Given this broad sell-everything panic, this intense focus on the AI bubble, what stabilizing factors might the markets be overlooking?
What aren't they seeing?
Exactly. You should keep an eye on the big institutional moves. The World Bank just appointed Pascal Donahoe. The IMF is really zeroing in on global financial linkages.
So the idea is that these deep cross-border connections might offer a bedrock of stability.
It's possible. A stability that markets, currently obsessed with domestic tech fears, just aren't pricing in yet.
Something to consider as you recalibrate your own risk profile. That's all for this deep dive. We'll talk soon.